we're getting more important watchers of the market and experts. Saurabh Mukherjea of Ambit Capital and Prabodh Agrawal of IIFL Institutional Equities are joining us now. Saurabh, good morning to you. How do you read this move as the start, as an inflection point, and therefore the FIs are going to bite and bite like hell?
I think clearly Raghuram Rajan won't have cut by 25 bits until and unless he has visibility that he at least got 50 to 75 bits of rate cuts in the tank. So I think it is safe to say that this should be the beginning of the rate cutting cycle, although I don't believe we've got, I don't think we've got heavy rate cutting ahead. What I think clinched the deal for the governor was the fact that 6 months into the oil price correction, with the World Bank decisively scaling back growth forecasts for the years ahead, it does now look that $70, $80 oil is probably not going to come back for a while. And I think once that comfort came, the RBI moved in line with its own targets, that 8% for this year, this January, and 6% CPI for next January were the targets it wanted to hit. And as the statement today makes clear, those targets are likely to be met, and hence a cut made sense.
Okay, so Dr. Kaushik Basu moved the needle and not Arun Jaitley, you think? Fine. But Saurabh, how do foreign investors normally react when such an event happens?
I think I can say without any hesitation this will go down well with most FIIs. A lot of our discussions with clients over the last 3 to 4 weeks have been about rates and nothing else. It's almost a talismanic feature of investment life that once the rate cutting cycle begins, the capex cycle begins after that. So I think cyclical should do well. FIIs will take this positively, and whilst we need to keep an eye on the rupee, as long as the budget doesn't disappoint on the fiscal discipline front, I think the rupee should also hold firm. So unequivocal positive, I think, from a FII perspective.
Okay, in fact, there is a big move that we're seeing on the rupee this morning. It's now at 61.75 versus a close of 62.18 yesterday. So huge appreciation. Saurabh, hi, morning. So if there is room for further rate cuts, how do you approach the rate sensitives now? Do you go out and just buy banks, auto stocks, real estate, or do you just continue to stick to the quality names that you were in any case buying before the rate cut?
I think a year and a half ago, we moved this heavily towards cyclical. Something like 70-75% of our model portfolio is in cyclicals, and I think that remains for us the sensible way forward. GDP growth is recovering, policy initiatives are coming through thick and fast. The rate cutting cycle has begun, so I think it does make sense to stay decisively heavily in favor of cyclicals. But as I've said over the last 2.5 years, in India you have to stay with good and clean. So even within cyclicals, stay in high quality names, well-run companies, good balance sheets, good corporate governance. There simply is no room for playing poorly managed companies, dodgy accounts, weak balance sheets. So autos does make sense in that construct. The better run industrial companies, some of the better banks in our country, the better NBFCs, and that should be the shape of a typical portfolio, heavily towards cyclicals, but high quality cyclicals.
Okay, stay on. Do stay on with us. Saurabh, Prabodh Agrawal of IIFL Institutional Equities is also with us. Prabodh, what is a trading strategy now? I mean, it's already 150 up on the Nifty. Is this a time to go ahead and buy even now for the current contract or for the current and next contract? Or do you think it's good to wait, buy, and you will get a better opportunity to buy?
Good morning, Lata. Unfortunately, we do not make trading calls,
okay.
So I would really not be able to comment whether, it's a good strategy to buy for the next fortnight or for the next 1 month. Our calls are fundamental with a medium to long-term view, so we make a 1-year call. Today is actually a wrong day to be making a bullish statements, because today everybody who was not bullish would also become bullish today.
That is exactly what I meant. I mean, should one go with the herd now or just stand back and that there is a better time to buy?
Yeah, so thinking that, that is a tactical call one may take, to wait But what we have been saying is that fundamentally things are improving. Even though markets may have done very well in 2014 and therefore people may have their apprehensions that the markets are running ahead of fundamentals, we thought that was not the case, and 2015 would be a good year as well, given that there would be turnaround in the macroeconomy, there would be a pickup in the earnings growth. Valuations seemed reasonable to us, and therefore, and more importantly, we would see huge inflows from both domestic as well as a reasonable inflow from the FI side. Now, all these are still relevant, so therefore, I would say that this 2% movement would change any of these. We would still be buyers, whether, that's up to individual, whether one wants to wait. But I really don't expect a major correction going forward. There's something which we have maintained over the last 6 months, that we do not see any major correction. That is because at the margin things are improving, and there are more people who have been left out in this entire rally, and therefore at every small correction there are new investors who come in, and therefore every correction is very shallow and short-lived.
Okay. Prabodh, hi, good morning. Just to take that point forward, do you think global turbulence could cap the upside for this market, or will domestic macros offset all of that, and we can see a fresh high on the market, in the next, say, couple of months itself?
See, I would say that, global macros are, we need to watch out for global macros, but I've always felt that here, our domestic factors are turning positive. The domestic investors will be big investors. Going forward, our reliance on FI flows will reduce. I would not say it would go away, but it would reduce compared to the trend over the last 6 years. So still, the global flows are important to us. They can cause short-term volatility. But, barring significant global events, significant global meltdowns, some large financial institution going belly up, or some countries defaulting, barring those kind of large events, I really am not too worried about global events. They could be short-term, as we saw in the month of December, where we saw significant FI outflows. But then the market reasonably held up. The outflow of the FIs was offset by large inflows from the domestics. I expect that trend to happen going forward.
Actually, let me toss both those themes that you mentioned, the Indian growth and the global theme, to Saurabh. Saurabh, has growth really picked up, or do you see it picking up quickly? The IIP number that we got last time, it was about, the index number was 167. I have read that number even in 2011 and 2010. So as a total output of goods and services, it has not increased. Is growth picking up, and the absence of that evidence in the third quarter numbers or the fourth quarter numbers can prove to be a ceiling? What is the legitimate gain you can expect from the indices up until, say, June 30?
I think that growth is picking up, and it isn't. I think I can answer the question in both ways. So in FY14, we had our 9-year low of 4.7%. First half of 15, as we know, we got to somewhere around 5.4%. My reckoning is second half of FY15 will be somewhere around 5.8%. This is enough that I've seen in the last couple of months to believe that that we are moving a little bit forward in second half, even compared to first half. So road traffic volumes are picking up. CV cycle seems to have picked up a little bit more. And then I think second half 5.8 looks likely. Now, is 5.8 a great number for India? I don't think it is, but it's an improvement on the 9-year low. On the question of returns, the market, I think, will continue to do around something like 25 to 30% per annum. So our March 15 target remains 30,000 on the Sensex, and our March 2016 target remains 36,000. And if you look back at the last 30 years, India has actually been a quite metronomic economy. The first 3 years of a 10-year economic cycle gives you around 30 to 35%. We've had a year or so of that behind us already, and I think we've probably got a couple of years of that ahead of us. So, cyclical recovery underway, rate cutting has begun. There could always be global events which could hurt us. It's very difficult to rule those out, especially given the way the Chinese economy seems to be floundering. But the domestic story is the best it has been, I think, for a good 4 or 5 years.
Okay. Saurabh, less than 24 hours back, there were a lot of recommendations on the FMCG space, how you should increase your allocation into FMCG stocks like, banking stocks like ICICI Bank underperforming, etc. Now, overnight, things have changed. So what do you do in terms of sectoral allocation? You pointed out that you would increase allocation into autos, but what about spaces like FMCG, which have been doing exceptionally well in the last couple of weeks?
And PSU banks.
So I'll take this question, ladies, and if you don't mind, after that I'll shoot off. On allocations, the point I was making was for the last year and a half, we've actually been at 70-75% of our portfolio in cyclicals. I'm not increasing that now. It doesn't make sense to increase after the rate hike. I think we were already heavily biased towards cyclicals, and we continue to maintain that bias going into the rate cutting cycle, going into the recovery cycle. Now, clearly, even in the remainder 25-30% of your portfolio, you'll have to have some high-quality names, and those necessarily will come from pharma, FMCG, and IT. I don't see any logic in increasing that weightage, but in that context, I don't see any reason for knee-jerk selling either. This is a fairly predictable recovery. It's a predictable policy cycle. I don't think anything has happened in the last 12 months, which is a bolt from the blue. And even going forward, the way inflation is easing off, rates are going to ease off, growth will recover. It's a fairly predictable recovery. Makes sense to stay heavily on cyclicals. Have a little bit of FMCG, IT, and pharma in your portfolio, but don't make jerky investments here and there. Those never really work out.
All right, point taken, Saurabh. Thank you very much for joining us. Yes, I agree. It's not a bolt from the blue. It's only the timing, perhaps, that was a bolt from the blue. Prabodh, the same question to you. What would your asset allocation be now for a fresh incremental 100 rupees if you got?
Yeah, so we do like financials, we like industrials, cement, we like IT. And we like auto. These are the 5 sectors that we like where bulk of our investments are. But of course, we would like to keep some investment in the FMCG and the pharma space as well. I think in the last 3-4 years, the defenses like the IT, pharma, and the consumer earnings were significantly superior to the rest of the market, and therefore the premiums, valuation premiums, continue to expand. Now, going forward, I believe the rest of the market will catch up, and the earnings for the cyclicals like financials and auto and cement and industrials will eclipse that of the defensives, and therefore I think the valuation gap will narrow. In that sense, I think the cyclical sectors will do well. So we continue to be overweight on the names in financials, industrials, auto. IT is one sector which I like because I believe that if with a 1 to 2 year view, there would be a gradual rupee depreciation. A 3 to 4% INR depreciation, annual depreciation, can add significant tailwind to the earnings of IT companies. So that segment which we like.
Okay. Prabodh, just one final question from my end. Just to get a slightly longer-term view on how FIIs would read this rate cut. I mean, we've seen FIIs on the sell side for the last, say, couple of weeks to months in this market. Do you think that trend has changed now or will change?
See, FIIs have, we know that the most gem fund managers are overweight on India. It's very well known that against a neutral weighting of around 8%, most gem guys have around 11 to 12% weighting in India. But the global guys have been less, enthusiastic on India because the developed markets were doing very well. But now that the growth of the developed markets has faltered, I mean the stock market returns of the developed markets has faltered in the year 2014, I believe many of these funds would be cannot be indifferent to India too long. And therefore, I actually believe that the FI flows would resume, even though there has been a lull in the last few weeks, but that should resume. And for the year as a whole, for 2015, you should see more asset allocation towards India. Because India is a fairly large liquid market, and while it is part of an emerging market, but people will have to take a view that India is a large enough market where one needs to allocate assets.
All right. We'll leave it at that. Prabodh Agrawal, thank you very much for joining us at what is a seminal moment for the markets. The first of the rate cuts after a fairly long gap, I think, of 3 years. And the markets smelling that this is an inflection point, a start of something big.